Terrific quarter, terrific growth. Obviously, you've been a big benefactor of this switch to telehealth over the last year, the acceleration of it. But one of the things that I think investors are trying to sort out is your guidance. On the one hand, you say that you have a great opportunity now with the integration of Livongo to do more cross-selling to employers. They want a complete package with management of chronic conditions. You ended the year with 51.8 million paid members, but you're only forecasting 52 to 54 million for 2021. That seems like really small growth given the opportunity.
Teladoc lost $199.6 million in Q1, and management has been on a nearly 2-year multi-billion-dollar spending spree like money grows on trees. My question is, does Teladoc have the right management in place to grow the company? Let me ask you, if someone you didn't know was offering you part ownership in a business in exchange for money, would you give them your money not knowing anything about how it operates? Now, I know that seems like an absurd question, but people do it all the time with investing. Now, I learned very quickly in my early investment experience that when you give business money with the hope of getting your investment back plus a reasonable return, and you know very little about the company or the management of the people you're going into business with, well, that's not investing. That's speculating, or let's just call it what it is. It's gambling. Welcome to MGA Investing. My name is Dee, and thanks for tuning in to the most comprehensive stock analysis of Teladoc on YouTube. And in today's video, part 4 of a multi-series stock analysis of Teladoc using a non-technical stock analysis process called the D.U.M.M method that I've used successfully for decades. And it's a stock analysis method that doesn't require a college degree, insane Excel spreadsheets, or chart reading skills. So, what is the D.U.M.M method? Well, D.U.M.M is an acronym. D stands for Durable Competitive Advantage. It measures the strength a company has to fight off its competition. Now, U stands for understand, meaning do I understand how the company makes money? M stands for management. Is management effective? M2 stands for margin of safety. Can I buy the stock at a discount? I devised this process to provide me a simple, reliable, and replicatable way to evaluate stocks without all the math. Because look, I came to realize one thing early in my investment experience, that no matter how good the math is, there's no crystal ball to the future performance of earnings of a company. And although there's no crystal ball, hope and emotion, well, those are not strategies for growing your returns and your investment portfolio either. You need the best available facts to substantiate your hunches if you're to be successful as an investor. Now, here's 3 reasons it's important to know the effectiveness of the management team of the company that you want to invest in. Number 1, a good idea is not enough to win long term. Someone thought pets.com was a good business idea at some point. In other words, a good idea is not enough reason to invest. Number 2, increasing competition. To face down competition while you're in the leading position, well, it requires vision, relentless execution, or you'll just get crushed by the competition. Your competitors learn from the expensive mistakes made early on as well as your successes. An investment bet on a management team that doesn't understand this can be disastrous. Number 3, vision. Provide a clear direction for the company. A good example of this is when the Apple board replaced Steve Jobs as CEO with John Sculley, former president of PepsiCo. Sculley was a Wharton MBA and accomplished business executive. Well, over time, Sculley had begun to depart from Steve Jobs' vision of computers for the individual and always looking for the future product development. What Sculley did is, however, he wanted to compete against IBM in the business space and was more concerned about current product lines and profitability. Although Apple Computer was for the most part profitable under Sculley, it struggled to find direction for its future until the return of Steve Jobs. So how do I measure management effectiveness? Well, here are 5 metrics that I use to measure management effectiveness. There's ROA, return on assets. This is how much profit a company can generate from its assets. That's usually about 5% or better. ROI, return on investment, measures the amount of return on an investment relative to the investment cost. 10% is usually a fairly good number for that. Now, this doesn't account for how long an investment is held, but it gives you a good idea. And then there's ROE, return on equity, or return on net assets, as it's sometimes referred. Essentially, it looks at how much profit a company can generate relative to the shareholders' equity. This is about how well a company uses shareholder equity. A good ROE, well, that could be somewhere about 14%. So here I'm taking a look at that return on assets, return on equity, and return on invested capital, and kind of summarize here. And I pulled this off of Morningstar, just type it into Google and return on assets, return on equity, operating performance, and you can pull this up free of charge. And so I pulled this up, and what I want you to look at here is on return on assets, as we look here, a good number, right? Return on assets, like anything above 5%, 10 better. Return on equity, 10, 15 better. Same thing on invested capital. But what we're looking at here is, now typically in a company that was been around for 10 years or more, you're looking for these numbers to be positive. This is a growth company. We're doing a lot of acquisition, expending a lot of money to get those economies of scale, which give them a competitive advantage. So we look at this, we see 2015, and then as we move towards 2020, we see a good trend and that those numbers are getting smaller. That's a good sign. When we look at return on investments, or at least return on assets, that we're talking about here on return on assets, we're talking about how much profit a company can generate from its assets. So we see that they're getting better and better with the assets that they have and getting a better return off those assets. That's a good thing. Now, return on equity. Now, we know return on equity or return on net assets, as it's sometimes called. It looks at how much a company can generate relative to the shareholders' equity. This is about how well a company, again, uses shareholder equity. And now you can see on return on equity, again, a good trend, right? These numbers are really high here. And then what we see is these numbers coming down. So that's a trend we hope will continue. It lets us know that, we've got some folks there at the helm that know what they're doing and they're bringing these costs under control. At the same time, they're trying to balance getting those economies of scale that make them harder to compete with. And then return on invested capital. This is about how well, for the capital that they have available to them to utilize, what type of return are they getting on that, right? So we'd like to see, 10, 15%, so forth. We're talking about a growth company, doing a lot of acquisition to establish that economies of scale. But again, you see a good trend here in the numbers, with those numbers going down and going in the right direction. So here's another thing that I'll take a look at. This is from my Fidelity account. These reports are made available for free within my Fidelity account. So I'll check this against some of the other data that I'm finding online. And so I'm looking at returns here on operating. So one of the things I know is that on return on equity, I know this is getting better, right? Because I just showed you that. But then I get to compare it to what the healthcare averages are in the healthcare technology sector. So this is kind of a sector comparison. I find that useful. On return on equity, it's just showing me the trailing 12 months here. But this is what I'm looking at here is this number here, because I'm looking at most recent and annualized return on assets. Again, we know that number is getting better, and this is where it is compared to the industry average, right? By sector. And then we look at return on investment. And then we can see here, again, negative, but we know why, but we know where we're going in terms of ultimately where the company wants to go, right? We want to be in the thick of it and producing better than the average, but that gives you an idea of where Teladoc stocks up compared to the healthcare technology average. Now, it's a little different than some of the other companies, but it just gives you kind of a bird's eye view at it. The other thing I look for is debt. Teladoc has historically financed its operations primarily from the sales of equity securities, that's selling shares of its stock, or debt issuance, that's bonds, and bank borrowing. And when I'm looking for debt, I'm looking for bank borrowing that shows up on the books by way of long-term debt. This is from macrotrends.net. It's online. Just pulled it up. What it can do is it can give me this information all kind of in a bird's eye view. So here you can see I have debt to equity ratio, shareholders equity, and long-term debt. And I'll explain each of these as we go through this. So as you can see here, Teladoc, they're sitting on a mountain of debt. And most of that is the result of, or at least I would say the vast majority of that is the result of the pace of acquisitions Teladoc has been on since 2018, with the largest being Livongo in October 2020. You can see here they finance their acquisitions through heavy long-term debt, right? So bank borrowing as well as shareholders' equity. So that's issuing of stock. The other thing that it's interesting about that, and we'll take a look at some of these numbers here. We see here, if we click here, we can see where each of these measurements are at a point in time. So for instance, this is March 31st, 2018. We see they have a ratio of 0.38. A good ratio is anywhere between 1 and 1.5, just kind of by standards in finance. You can see shareholders' equity. It's about $550 million at the time. That was back in 2018. And their long-term debt was just about $210 million at the time. And so you can see over time, particularly when we get right about to 2018 here, we start to go up a little bit. And most of that is because that's one of their first acquisitions that they did, which was Advanced Medical. It was like $351 million. That was a combination of both cash and stock. That was back in May 2018. So we should start to see some of that. We come in here. So that happened right about in here. Okay. So that it looks like they're able to manage that. So I like what I'm seeing here because it looks like they're managing that balance between shareholders' equity, that's selling shares, and long-term debt. And they're using both of those to finance the operations of the business, to help handle some of those acquisitions, very strategic acquisitions that they're doing. And at the same time, they're managing that debt to equity ratio. Why is that important? Because if you manage and you keep that lower debt to equity number, what that does is it improves your overall credit risk. So when you do need to go back to a bank and you do need additional money, you have a better chance of getting that because you're much better credit risk because you've managed these pieces of finance, these finance tools here. Look over here, we go just a little bit further down. And let me get into here. And there we go. So we're into 2020, right? And now we're at 0.95 billion, right? So what that means is $950 million in long-term debt. So we know in July coming up in 2020, they purchased InTouch for about $150 million in cash and a combination of cash and stock about July 20. So another acquisition. And then we get into, see if we can find October here, or close to anyway. So we're somewhere in between these two. The Livongo acquisition happens, $18.5 billion in cash and stock, kind of a combination of that to bring that together. So you can see this number jumping up to grab enough money to be able to make that acquisition and to make that happen. And so you see that. But at the same time, down here on the bottom, you'll notice that down here, let's see if I can get down here on that same date. Look at the debt to equity ratio. So very well managed in the way that they're managing debt. And I like that a lot. That debt to equity ratio, very important. It compares the amount of equity, that's what the company owns in terms of funds, and debt a company is using to finance its operation. So again, like I said, the lower the better. 1 to 1.5 is considered good. Now, another thing that not showing on here, but that I usually will look for is a thing called off-balance sheet debt. Now, this is an accounting method that's used to keep some assets and liabilities from actually showing up on the balance sheet in order to keep debt to equity ratios low and improve the company's credit risk. So Teladoc doesn't have any off-balance sheet debt, which is good in my opinion. Another area that I like to look at is management compensation. So this is the kind of the final piece that I like to look at as part of this 5-piece metric. And compensation, it really drives behavior. There are several places you can go to get this information at no cost, websites like salary.com that I'm using here, and you can take a look at and see what compensations like. You can look at by year to see how that compensation has developed over time, and you can go back in time and look at CEO pay and to see how it's grown. So here we can see Jason Gorvick, CEO, $8.4 million. Stephanie Verstraete, and you can see here she's about $2 million. David Sides, and so forth. So you can see those top executives exactly kind of where they're making this. Now they're pulling all of this off of the proxy statement, and I'll show you where you can get that as well. But this gives you kind of a graphical look at their salary. So one of the other areas that I like to use is exec pay. So you can go to execpay.org, take a look at it over year by year. And here we're just taking a look at 2020. We see it's Total compensation is $8.4 million. Part of his plan is compensation breakdown. And that's what I like about exec pay. We can get here, we can see that non-equity incentive plan is $1.1 million. His salary itself is it's such a small portion of his pay. It's just over $500,000. Stock awards seem to be the biggest part of his pay, $6.8 million. And there's some other things set in there, 11,400, and then total pay 8.4. Now, look at this. Gorvik received 6.8 million in stock awards, accounting for 80% of the total pay in 2020. It also says Gorvik received 1.1 million in non-equity plan. So that's his salary and then this other compensation that makes it up. And so in rankings, we can see in 2020, Jason Gorvik's compensation ranked 797th out of 8,000 executives tracked by executive pay. And so it shows that he earned more than 91% of executives. So there's other sites that you can go to that you can take a look at this information as well. And this is free. You can type in Teladoc 2020 proxy statement. So another one I like to look at is if you just type in the name of the company, Teladoc SEC Schedule 14A, this gets you the detail. When you Google these, you want to make sure you find the most current, because some of these will throw you off into the previous years. And so you just have to kind of click through these until you find the one that you're looking for. So it looks like this to be the latest one. And sometimes you have to be careful too, because if they own multiple companies, you might click one of these and it's Livongo, but you need the parent company. And so here we got April 7th, 2021. Let's just kind of sneak a peek at that one. And so it says Form 14A, Teladoc Health. So we're in the right place, U.S. Securities and Exchange Commission. And then what we want to do is, and we're going to scroll down, and there's the file right there. And so we're just going to click that file, and then here we go. So we have Schedule 14A for Teladoc, and then let's just verify our dates. So this is the most recent, and that's what we want, whatever the most recent is. And then we're going to look for compensation. So there we see director's compensation, and then non-employee director compensation. We don't want that. We want executive compensation and executive officers. Okay, we're going to take a look at compensation philosophies and objectives as well. There we go. That's what we're looking for right there, the summary of compensation table. And so we can see here, and let me see if I can blow this up just a little bit more for you guys so you can see that. I hope you can see that. So you see Jason Gorvik, and you can take a look at by year. You can see what that salary is doing. And then you can also take a look at stock awards and see how that's improving, at least for him, right? And then various option awards he's received, non-equity compensation. You can see how that's going up. And then we can see also what that total is, that $8.4 million that we talked about previously. So those are some different ways that you can dig into, get a little bit more granular about that compensation. Because if you tell me where an executive pay comes from, I'll tell you what his or her is most focused on. And so this Schedule 14A is another way you can do that. This information is free, that you can see that. And then another thing I want to take a look at, because we want to see what some of these objectives are. The other thing we're looking for is this compensation philosophy and objectives. It's going to tell us a little bit more about why they pay the way that they pay these executives. So let's take a look at that. So it says we address our philosophy, programs, and process related to compensation. Okay, so let's just kind of dig through here. So it says here the primary objectives in this compensation discussion analysis. This is where we get a little bit more information here. It says this is where we address our philosophy and program processes related to compensation. Okay, this is for the executives. It says, and here we can see establishing executive officer compensation. And so these are some of the objectives: attract and retain individuals of superior ability and managerial talent. That proves out in the numbers over time. You can't hide that. If we've got the right people, those numbers should shape up. Ensure compensation is aligned with Teladoc Health's corporate strategies and business objectives and the long-term interest of Teladoc's Health stockholders. Enhance incentives to increase Teladoc's Health stock price and maximize stockholder value by providing, right here where I'm reading, since incentives to increase Teladoc Health stock price and maximize stockholder value by providing a portion of total compensation in Teladoc's Health equity and equity related instrument. And then promote, this is that kind of good feeling stuff, promote teamwork while recognizing the individual role each executive plays. Okay, so that gives us an idea of how that's broken out. And here we can take a look at how they achieve those compensation objectives. So base salary is to recognize performance of job responsibilities and attract those individuals. Annual cash bonuses provide incentives to attain short-term financial and operational goals. And then the big one here, long-term compensation, promote and maximize stockholder value by aligning the interests of employees and stockholders. I'd like to know what's driving that behavior. Again, if you tell me how an executive's being paid, then I'll tell you what they're most focused on. And so when we went back here, let me go back, and we see what's the main driver. It's those stock awards right there, right? So the overall performance of the company, as well as the stock itself, how it's performing, should be a reflection of how the company is performing. And as you know, Teladoc stock had a nice little lift through COVID-19 in a big year, so that's going to be reflected in his pay as well. Now, I have to admit, these 5 metrics are all a bit more tricky when working with growth companies without a 6 to 10 year track record of profitability. But we use the information we have available to make the best possible decision. I use these to determine, in my limited opinion, are the right executives in place? And are they making the right decisions for the business long term, or is it just a money grab for a bunch of executives? If you found this video helpful, give us a thumbs up, leave us a comment, and please subscribe. Because in the next video, I'll conclude my stock analysis of Teladoc using the D.U.M.M method. And then in that video, I'll actually talk about the final M, margin of safety, where I talk about the possible entry points to buy the stock at a discount without all the math. Thanks for watching. We'll see you next time. Make sure you go back and take a look at our previous videos in the stock analysis series about Teladoc. The first one is an overview, which is just a general overview of the company and how we do that. And then the second one, we talk about whether or not Teladoc has a durable competitive advantage. The third one in the series is that is, do we understand the way they make money? And we break out how Teladoc actually makes money or doesn't make money. So make sure you go back and take a look at those videos. And if you would like to invest but don't have the money to do so right now, I'd encourage you to visit our sister channel, Money Growth Academy, to learn what you can do today to make more money, to pay off debt, and be in a position to begin investing.